Hello, everybody, and welcome to 2024. We were going to do this video a few weeks ago, but we just haven't wanted to bother you because things have been going along great. If you've been looking at your statements or if you've recently reviewed with Jessica or myself, you know that you had a really good year in investment performance last year, especially in the fourth quarter. Not coincidentally, it was as it became apparent that the Fed was finally done raising rates. We've had a lot more economic data come out in the last few days, and it's given us the opportunity to do some changes in the portfolio that we've been waiting to do. So, Bob, why don't you get into the weeds a little bit and tell people what we did this week and why?
Sure. Bottom line is we increased our interest rate exposure, which is something we have to really go back to the beginning. Bruce, when you and I started this process now more than 6 years ago, one of the things we did was we were systematically underweight duration versus the benchmarks. And duration is just a fancy word for interest rate risk. The reason that we did that is because if you look at the long-term historical returns of bonds, we believe they greatly overemphasized what a bond's going to return given the current zero interest rate environment we went into. They suggested bonds would return around 6 to 7% a year, which that seemed impossible to us, seeing as bond yields are closer to 0%. So this is the first time since we incepted this process that we've actually moved up to the benchmark weight. And the reason we moved up to the benchmark weight is because with all the stimulus, et cetera, we finally got some inflation in the system and interest rates moved up considerably. So as interest rates have moved up, we've still been underweight duration, and we've been able to add a lot of value relative to benchmark, and certainly great for our investors. We're actually at a point now where interest rates are high enough. We continue to see this falling trend in inflation despite the higher than expected numbers this week. We believe there's a randomness to the monthly numbers. So it was time for us to actually take on the benchmark average, the industry average interest rate exposure that's out there. And that's the first time we've done that since we accepted this process more than 6 years ago.
So, Bob, we've been out of international for quite some time, over a year, I think. Do you have any thoughts on whether or not we're going to add more international to the portfolio here in the next year?
Yeah, probably not is the answer. I don't see a pressing need for it. There's two components to international return. There's what their local markets do, right? Their stock markets do, their bond markets, et cetera. And then the second component is the currency component. So let's just start with what we call the local component, which is what their markets are doing. While our economy, GDP now just came out again, they've moved their expectations now up to about 3.2%, I think, for Q1 GDP in our country. Europe is still flat on its back. It just can't get out of that sludge it's in right now. It's trucking along around flat. Whether they're in a recession or not, I guess is debatable, but their local markets aren't performing very well because their economy is not growing. So there's not really that incentive for us to go, and invest in those markets. If you look at capital flows, et cetera, coming to the U.S. Now, as capital investment flows from Europe to the U.S., the other thing that does is it strengthens the dollar. You're effectively, in the case of Europe, you'd be selling euros and buying U.S. dollars. That strengthens the dollar. So that again is another headwind. I mean, it's a tailwind if you're a U.S. investor domestically. It would be a headwind if we invest internationally, because if we put our money over in euros, not only is the local market underperforming, but the currency is also weakening. So it's kind of like a double whammy to us. And so right now we're not in international securities. Again, it's treated investors well. The dollar is up about 3% this year versus the euro. It's up against the yen this year, and their local markets are underperforming. So, I don't see it in the immediate future right now.
Bob, the last thing I wanted to ask you today while we have you, and before I do that, to all of our clients out there, we have these discussions every Friday morning, and we review what we're doing, but we're also always testing our process. Yeah. As Bob mentioned, he and I have been using this process now for better than 6 years. And thankfully, on the long term, the process has been working swimmingly well, but it doesn't mean that we don't continue to test it. So we are not big prognosticators, but people always want to know what we think. So Bob, what do you think the rest of 2024 lends to our clients?
Yeah, yeah, it's also a good chance for us to go back and, give a quick refresher. Our process is not a macro-driven process looking at geopolitical things. So we're not going to, what does the rest of 2024 hold? Well, we're not going to guess what's going to happen in the presidential elections or with Vladimir Putin or anything like that. We're just looking at the economic data. And when we look at the economic data, we've been in the minority saying there's no recession coming in 2021, 2022, 2023. And while everybody seems to have left the recession camp finally, there's no indication of it coming in 2024. Credit conditions are still pretty good. And we don't see the second wave of inflation where, it's all but certain the Fed's not raising rates anymore. So if we're not going to have a credit crunch, workers are employed, they have income. We're not sure, we're not, we remain pretty constructive. Oddly enough, it's, I guess we're one of these people that have to always have something to worry about. So the last, many years here, everyone's been worrying about recession. Now we're actually starting to worry about melt up and stock prices. You're seeing the stock market start to take off. These latest higher inflation numbers, I think probably positive in the longer term. It takes the pressure off the Fed from having to ease too early. I think it's going to slow the markets down enough. So I think if the Fed was cutting right now, stock markets are just going to go up and up and up, and we're going to create sort of a melt-up bubble almost. The start of this year, we had, I think it was 9% was our point estimate. There's obviously room around that, the spirit of it being that we think we're going to have a normal year. I'm still in that camp. I'd say that the danger is that we're already up several percent this year. I think the danger is that we maybe sort of get a little bit ahead of ourselves this year. And if that happens, maybe we'll get a little more defensive. But I don't see a sign of recession. I definitely don't see these latest inflation numbers this week being some sort of a Twin Peaks in inflation 1970s scenario. So all is well right now.
Yeah, thanks for your commentary and your time. To all of our clients, hey, happy tax season. Make sure you get your tax returns sent over to us so we can review them. Jessica and I have already been digging in on tax returns. For those of you that have turned it in, we've actually even bought some new software to help us in advising you on tax planning. But most importantly, we want to say thank you for your business and for trusting our firm. Have a great day. Bye-bye.
Bye, everyone.
Bye-bye.